Could that technology of the future sitting in your wallet right now actually be someone else's exit ticket to wealth? If you've invested in the last few months out of fear of missing out or FOMO, you might as well be a fish waiting to be hunted in the middle of the ocean. Today, we are decoding the biggest lie in the financial world, how the smart money silently turns your savings into their own exit strategy, backed by evidence and the bloody charts of history. After this video, you will never look at an investment asset the same way again. Welcome to Echoes of Finance. So do you really know how a financial bubble is created? Have you ever considered that the project, that technological marvel, sold to you as the future, is actually just a safe exit strategy for insiders? The financial world has repeated the same vicious cycles throughout history. Everything starts with an innocent story, a revolutionary invention, a new software that will change the world, or a promise of unlimited profit. They make the public believe in it so much that this investment turns into a financial religion. Questioning is a sin. One must only believe and invest. People stop investing in real value creation, the company's balance sheet, or the quality of the work, and start investing in the hope they will sell to someone else. The system is simple. First, a magnificent altar is built for the public. The insiders, those who started the bubble from the very beginning, quietly step aside while prices are rising. For them, it is time to exit. So, when the insiders exit the system, to whom do they sell their depreciating assets? Naturally, to you, the most loyal follower of that religion. Today, we will decipher how this mechanism works, how the public is turned into victims, and the historical echoes of this phenomenon. Financial history is actually a graveyard of mistakes and forgetfulness. Think of the famous hyperinflation in Germany in 1923. People believed so strongly that the system would work forever that they completely ignored fundamental economic realities. Even in those days when money became worthless, the blind belief that prices would be even higher the next day was actually the ancestor of today's hype culture. Or let's consider the economic depression in Chicago in 1948. People acted with the same greed and the same fears. All these crises in the past have one thing in common: a new era narrative. People are told that the rules have changed and that old economic laws are no longer valid. The modern investment tools of that day were actually nothing more than hollowed-out debt instruments. The aggressive, manipulative marketing strategies we see today in crypto exchanges or rapidly growing tech stocks are not a bit different from the methods of the stock jobbers of the 1920s. History shows us painfully that if an asset is marketed more for its story than its value, a trap is being set. The past whispers to the future, but only those who know how to listen can escape these traps. We must also look at the 17th century tulip mania. It was the first time in history that a single commodity or flower bulb became a vehicle for rampant speculation. People traded their homes, their lands, and their entire livelihoods for a bulb that had no utility other than its aesthetic beauty. Why? Because of the narrative. Everyone said tulip prices will only go up. It was the same blind faith we see in today's meme coins or overhyped tech IPOs. When the realization finally struck that these bulbs were just plants, the market evaporated in a single day. Because of the narrative. Everyone said tulip prices will only go up. It was the same blind faith we see in today's meme coins or overhyped tech IPOs. When the realization finally struck that these bulbs were just plants, the market evaporated in a single day. The people left holding the bulbs were not the traders, not the smart money, but the common citizens who thought they had found a shortcut to nobility. This is the oldest lesson in the book, yet it is the one we refuse to learn. So how is this bubble created today? Let's look closely at the steps. Step 1. The story. A narrative that excites people's imagination and offers a grand promise. People are first presented with a problem, then told that this asset will solve this problem forever. Step 2. Valuation. As the crowd that believes in the story grows, the price of the asset decouples from its real value and accelerates upwards. This point completely deactivated. Step 3. Collateral. These inflated assets are used as collateral to borrow money. The system looks richer on paper. Everyone invests more with debt, and everyone thinks they will earn more with leveraged trading. Step 4. Debt. As debt increases, the system becomes fragile. Everything becomes a chain of interconnected debts. When one link breaks, the entire system is doomed to collapse like a house of cards. And step 5. The crash. When insiders have made enough profit or realize the risk, they start selling. The magnificent altar built for the public is destroyed. The ones who suffer the loss are those who bought at the very top and were the last to join the system. When charts are rising, everyone is an expert, everyone is winning. But when the selling begins, that religion suddenly falls into silence. The even scarier part is that these processes involve not just economic, but deep psychological manipulation. The human mind is caught between fear and greed. As the price of an asset rises, people lose their ability to think rationally due to the fear of missing out. Or FOMO. At that moment, the amygdala, the emotional center of the brain, takes over, while the prefrontal cortex, the center for logical decision-making, goes quiet. Manipulators target exactly this point. Those fancy infographics on social media, slogans like "We're going to the moon," are actually weapons designed to bypass your biological defense mechanisms. Large investment funds and whales who receive inside information measure this psychological vulnerability of yours with algorithms. They know statistically when the price will peak and when the public's excitement level will reach its climax. For them, this is just a mathematical calculation. For you, it is the destruction of years of accumulated savings. Lead to the cognitive traps. There is a concept known as the Dunning-Kruger Effect in finance. When a market is booming, every amateur becomes a self-proclaimed trading genius because they are merely benefiting from a rising tide. They mistake a bull market for their own brilliance. When the trend reverses, they are the last to acknowledge it because their ego is tied to their success. They ignore the warning signs. They double down on losing positions, and they justify their errors with irrational optimism. This is precisely how the smart money strips the retail investor of their capital. They wait for this exact psychological peak of overconfidence to distribute their holdings. Another dimension is corporate manipulation. In the past, stock market rumors circulated behind closed doors at dinner parties. Today, these rumors have become a 24/7 global digital noise. A stock analyst or a famous influencer can affect the decisions of millions with a single tweet. This is the greatest virus of modern finance. Corporate capital uses these influencers as a marketing channel. They are given the appearance of independent analysts, but in reality, they are all pawns serving the game of insiders. Corporations create complex derivatives, virtual assets, and valuations that never existed to extract liquidity from the public. The money invest isn't going to a real asset, but to a debt-covering fund in someone else's wallet. Within this cycle, there is a concept called smart money. Smart money never goes in the direction of the herd. While the herd is buying with excitement, they sell. While the herd is selling with panic, they buy. They call what you call the project of the future exit liquidity. That is, the fresh money invested by the public needed to exit the system safely. Think about the dot-com bubble of the late 1990s. Companies with no revenue, no product, And no business model were valued at billions simply because they had singlequotes.com in their name. Investors were blinded by the promise of the internet revolution. They ignored the balance sheets. They ignored the fundamental laws of profitability. When the bubble burst, trillions of dollars in value evaporated. We saw it again in 2008 with subprime mortgages. Banks packaged toxic, uncollectible debt into investment-grade securities and sold them to pension funds and average families as safe investments. They were selling a lie, and the world bought it until the entire global economy nearly collapsed. Today, we are seeing a similar architecture in the crypto and tech sectors. We see tokens being minted out of thin air, given massive valuations, and then sold to retail investors under the guise of decentralization. Decentralization is a beautiful concept, but when used as a marketing shield for centralized manipulation, it becomes a tool of oppression. Let's dive deeper into the technical dimension, the world of those whales. Today, financial markets have moved out of human hands and into the control of high-frequency trading algorithms, known as HFTs, while you look at the screen and think the price is rising. In the background, artificial intelligence models executing thousands of trades per second are hunting for weaknesses in your order book. You don't need massive amounts of money to manipulate the price of a crypto asset. You just need to steer the liquidity of the market, that is, your buy-sell orders. These algorithms can keep the whale's orders hidden while reading the small investor's orders in advance. This is like playing against the house in a casino. But the house isn't rigged. The house knows your moves before you make them. In the 1929 Great Depression, people were shouting and screaming in stock exchange halls trying to do something, while today those silent, cold computer servers can strip you of your entire future in milliseconds. This system we call modern is actually the wildest and most unregulated version of the past. Have you ever looked at the software code behind the platforms or assets you invest in, or the systemic risk that code contains? Often, a massive amount of tokens or shares held by a whale creates enough selling pressure to crash the market instantly. While creating this pressure, bad news is served to social media to panic the market. The news breaks, the algorithm starts selling, you get scared and sell because you ask why is it falling? And they buy back what you sold at the lowest price. This is the destruction cycle of modern finance. Throughout history, the name of this game changed. But the rule never did. The herd always walks the route set by the shepherd, and in the end, they are slaughtered where the shepherd decides. Consider the role of leverage. Leverage is a double-edged sword that cuts deepest into those who least understand it. When you trade with borrowed money, you are not just betting on the asset. You are betting against the mathematical certainty of market volatility. Algorithms are designed to hunt for leverage that tracks illegals off the market. When the price hits a certain point, thousands of leveraged positions are liquidated automatically, creating a cascading effect. This is not a market crash in the traditional sense. This is a calculated liquidation event. The whales push the price just far enough to trigger these liquidations, and then they use that forced selling to acquire more assets at a massive discount. They are literally profiting from your bankruptcy. Ask yourself, if this technology is so revolutionary, why is its value constantly determined as a tool for speculation? Why does something marketed as the project that saves the world one day go down in history as a fraud case the next? Because real value is patient. Real value is built over time. Speculation, however, is hungry, fast, and deceives you with the promise of making you rich instantly. Perhaps the most fundamental thing you should understand in this journey is not to surrender your financial destiny to other people's social media posts. Analysis is not just looking at candle charts. Analysis is reading the human weaknesses in the big picture that draws those charts. Remember, markets are not just math. They are also sociology and psychology. When people are afraid, there is a collapse in the market. When people are excited, there is a bubble. Are you in the middle of this excitement or fear, or are you a cool-headed observer watching from the outside? The choice is yours. But never forget this, there is no free lunch in the financial world. When someone wins, that money necessarily comes from somewhere. And that somewhere is usually your wallet. To protect yourself, you must adopt a philosophy of financial stoicism. This means distancing yourself from the emotional noise of the market. It means valuing information over noise. When you see a chart or a news headline, ask who benefits if I react to this. If the answer is a large institution, an influencer, or a project founder, you are likely the target. Always look for the unseen. When a project claims to have revolutionary partnerships, ask where the revenue comes from. When an exchange claims to have unlimited liquidity, ask where the capital reserves are stored. Most importantly, diversify your skepticism. Do not trust a single source. Verify everything. Use on-chain analysis to see where the money is actually moving. Remember, in a world dominated by algorithms, your best asset is your critical thinking, your ability to pause, reflect, and remain disconnected from the herd's madness. Whenever you look at an investment opportunity again, put your emotions aside and ask yourself these questions. Does this asset have a real cash flow behind it? Or is it just the money of new investors? If it doesn't sell a product, if it doesn't produce value, it's just a wheel spinning with your money. Secondly, who is marketing this information to you? Those VR or say don't miss out. You will get rich are usually selling you their own exit tickets. Learn to track on-chain data. If large whales are quietly selling while the crowd is excited, this is the biggest warning sign. A real investor is not in the crowd, but behind the data. The market doesn't want you to be rich. The market wants you to transfer your money somewhere else. Once you accept this truth, you stop being a part of the system and become a player who manages their own risk. No one makes money for anyone else's benefit in financial markets. Although it is easy to access information in today's world, it is harder than ever to distinguish true information from manipulation. Charts shared on social media platforms, projects under the name of next-generation investment, are actually traps set for you. Remember, everyone manages their own risk in financial markets. Do not be liquidity for someone else's profit. Question, analyze, and never believe blindly. History is full of the mistakes of those who followed the game of the system, not those who were conscious. We here, as echoes of finance, are here to bring the echoes of the past to the present and help you spot these traps in advance. If you liked the video and think these analyzers improve your financial literacy, don't forget to subscribe to the channel and turn on notifications. Remember, markets are always like an echo. You get what you give. See you in the next echo.